Good morning, everybody. This is Paul Crane again, back. Welcome to our session today. Today, we're going to focus our discussion purely on the equipment rate calculator. Remember on Tuesday, if you were there on Tuesday, we talked about calculating labor rates. Well, today we're going to talk about how do you calculate the appropriate hourly rate for your different pieces of equipment. And what we're specifically, it's going to follow much the same kind of outline as we did on Tuesday. I'll have some general introductory comments, just do a brief overview of the structure of how the calculator is put together and how it works. And then I'll give a little bit of just some commentary on equipment rate perspective. And then we'll look a little bit deeper at the calculator and how it actually works. And then we'll pause in there periodically. If you have questions at any point, please post a question on the question box there, and Linda will be monitoring the questions. And we'll be more than happy to pause, as we need to. I am going to now change my view here. Just one second. I want to change over so we're looking at control. Everybody should be seeing control.
Yes, we are.
And what we're focusing on, just like we did on Tuesday with the equipment or with the labor, I am on the production in the taskbar and specifically adjust part information. And then I have chosen view parts by type and have chosen equipment. And then I'm looking at all of the active equipment part templates. So this is the part name, and the end result of the equipment calculator for each of the devices that you may want to look at and examine what the hourly rate should be. The results of that calculator are going to be entered in the unit cost field of each equipment part that you want to update, okay? And then each equipment part, just like labor, has a multiplier. If you're doing costing only, really the only thing that's of significance is the hourly rate. If you're doing cost-based pricing, obviously the cost is critical, but also the multiplier. And I'll just, in a general sense, the equipment multiplier tends to stay around the value of 2, like you see. There may be appropriate reasons to go slightly under 2, and there may be reasons to go above 2. But generally, it's in the 2 range. Now, just some general comments I want to make. Whether control is being set up for the first time or you've been using it for a period of time, it's important that the control hourly cost for equipment be as accurate as possible. And it's even just as important to periodically review those hourly rates. The hourly rate is based on some general and equipment specific information. The general information includes how many holidays the business is closed during the course of a year, and also how you want to handle cost of funds. And I'll comment more extensively on what is meant by the cost of funds. Then the equipment specific information is quite a lengthy list, and I'm just going to mention 2 or 3 of them because we'll see exactly what all is involved as we go into the calculator itself. But basically, it's the how many years of life does it have left in it? How many hours per day is it used? What's the cost of any dedicated workstation and related software that's required? What's the actual cost of the machine itself? And then there are some other things that we'll look at as we actually look at the calculator itself. Now, because of the importance of having accurate equipment rates, we CyrSkills encourage you to consider using the equipment rate calculator. Do that as an aid to yourself. The use of the calculator assumes that there's a setup person in the business that will be tasked with coordinating, and I stress the word coordinating, the gathering of the needed information so that you can produce the actual estimated equipment rate per hour. Now, because of the sensitive nature of some of that information, it's quite likely that the setup person isn't going to have access to that information themselves. And because of that, the use of the tool involves not only the setup person, but someone in the production area that is very knowledgeable of how the equipment is used and what the equipment pieces are that they want to examine in more detail. So the production supervisor or production manager will be in the loop. And secondly, to gather all of the cost related information, that probably would need to include an accounting person. Now, the equipment tool itself is an Excel tool, and it's available to anybody that has access to the CyrSkills.com website. And to get the equipment rate calculator, number one, if you look at on the GoToWebinar control panel under handouts, if you select that, download not only the equipment calculator from today, but also I think there are some other files that are there that can be downloaded from the Tuesday session. So what I want to do now is switch to the calculator. Okay, you should be seeing the calculator. Just like the labor one that we looked at on Tuesday, the overall structure is very, very similar. So there's continuity in how they're laid out to be used. Up here in the gray bar is just simply the title, what it is that it's all about. What's the purpose of that worksheet? And then a series of instructions or steps. So in the case of using the equipment calculator, there's 5 steps involved. And those steps involve the setup person sending this worksheet to the production person. And that production person is going to complete the information in section A. He's going to provide a list of all of the devices, each piece of device that they want, and establish what the hourly rate is. And the worksheet is set up so that it can accommodate 20. If you have more than 20 pieces of devices, just break them up in whatever order makes sense to you, perhaps by category, or perhaps by those that are the most frequently used, and just break it up into multiple steps. That person is going to create the list, and they're also going to indicate what is their best judgment What's the best judgment of how many years that piece of equipment has left in it? It's quite likely that it may be fewer years, perhaps even than what it was financed at. It might be financed at 10 years, but its actual useful life that's left might be only 5 or 6. And that could be partly because of the age of the machine itself, but more importantly, probably any significant changes in technology that have simply warranted, made it so that it's not as proficient as it should be. And then the other absolutely critical value is the best judgment on how many hours a day that machine is used on average. We'll see the sensitiveness of that piece of information later. Then when the production person has finished these 3 things, made the list, put in these other 2 values for each machine, then he's going to save that and send it back to the setup person. At that point, the setup person simply is going to email or send this file, this worksheet, to someone in the accounting area, the appropriate contact there. Then for each machine in the list, they're going to have to provide all of the fields that you see here, the year that it was purchased, any information on cost of funds. We'll talk about that in a bit. How many years it was financed. What's the cost of any work-related software for that machine? What's the actual cost of the machine itself? And then finally, if it's under a service agreement, what the annual cost of that service agreement is, plus any out-of-pocket expenses, related to maintenance, maybe for things that aren't covered in a service agreement. It could also, if any of the software for the dedicated workstation is on a subscription basis, an annual subscription basis, then that would be included in the annual maintenance cost. Now, we'll see when we go through with an actual example. As this information is being entered, the results are being calculated in this results column, the blue column. So as the information is being plugged in, so to speak, the answer or the results of that are going to be displayed. So when the setup person is done, when the accounting person is done, they return the file to the setup person, and now that setup person, basically his work is mostly done, except for going through and just kind of verifying things and then reviewing the results with the production contact. Want to make sure that production person doesn't see anything that appears to be inappropriate, incorrect, so that they can make adjustments before any of the hourly rates are entered into control. Now let's comment on what you see in the black or the dark gray areas here, and then these 3 here. Those are samples. They're simply entered to give you a perspective of how it works. So the example was that we're 8 days that business is closed for holidays, excluding weekend ones. And we've said that the default cost of funds is 4.25%. Now, what do we mean by cost of funds? The cost of funds is, let me widen this out so you can see a little bit the whole note. The cost of funds, got to widen it a little bit further. The cost of funds, if the machine was purchased and paid for by a loan, then the cost of funds is the interest rate of that loan. Okay. If the machine was paid for in cash, in other words, the business, they took it out of assets and paid for it, then that cost of funds is the lost earnings on those funds. So the rate might be significantly lower, but it is still important, and it should still be treated as a cost when calculating the hourly rate. Now, there may be circumstances that the accounting person simply doesn't want to include cost of funds in the calculation, and that's okay. I'd prefer to see it included, but the only thing that they need to do to say no, don't consider cost of goods, is enter the word no there. Now pay attention to this column right here. I entered no, and the values there went to 0. That simply said, now watch it again, I'm going to change it back to the 4 1/4. Now it recalculates. When I said no, pay attention to the hourly rate in column N. When I say no, that rate goes down. Okay, so as you can see, the cost of funds have a fairly significant impact on the hourly rate that's for each piece of equipment. Now, notice also in the section B information, there was this thing called custom cost of funds. What that means is that for this specific machine, we're saying, no, the cost of funds is 4%, not 4 1/4. The one that's blank, we're saying, use the default, whatever it is. And then the third one, it says, no, this is really a cost of funds for lost earnings, and we want that to be based on 2%. Now, whatever you put in this custom field, if the answer up here at the top in step 4 was no, it doesn't make a bit of difference what these other values are in the custom area. They're not considered at all. Okay. Now I'm going to skip myself forward, and we're going to look at an example. And we should be looking at an example now. And it's basically the same as what we looked at before. I kept the 8 hours. The 8 hours, 4 1/4. And now we've entered in the equipment specific information, 14 different devices. These were the useful life in years. This was the hours per day that the production person said that were relevant or appropriate for each of the machines, the years that they were purchased. Notice that I left all of the cost of funds out, okay? So in that case, it's going to use the default of 4 1/4 across the board for all of the different pieces of equipment. The number of years for calculating the cost of funds, and notice that in every case, the useful life is less than the cost of funds years. This one is of particular interest. This particular machine I would question the accuracy of this. It was financed over a 10-year span, starting in 2011. So the 1 year remaining of useful life is purely being driven by the 2011 purchase. Okay. So the results are in this column N in the blue background. So if you were to go back into control, these are the specific hourly values that would be entered into the unit cost area of each of these respective parts. Okay. And we haven't commented at all on the multiplier. That's pretty much a judgment. It's not even significant as far as the calculator itself is concerned. But I want you to look now at for this specific example, I'm going to put in no for the cost of funds, and just kind of pay attention to what happens to these rates, specifically some of the ones that are maybe significant, the 19 and the 59. So I'm going to change that. This one for the Durst came down from 59 to $50 an hour with no cost of funds being considered. Let's bring that back. And let's say that particular machine had a 3.5% custom loan at the time that it was purchased in 2014. Well, that reduced the rate from based on the 4.25% interest rate to 3.5%. It brought the hourly cost down by a dollar from 59 to 58. Let's say that one of these was purchased on a cash basis, and the interest rate was 1.5% on the cost of funds at that point. It'll probably have not a whole lot of significant impact. Probably the one that's the item that has the two items that have the other items that have the significant impact. The first being the default cost of funds. The second is the useful life. And the third is the hours per day. Now notice that several of these have 12 hours per day as the hours used per day. That's because this particular client was operating a dual shift. So their work day was really 16 hours. And they're saying that each of these 5 or 6 machines work on average 12 hours a day. Not unreasonable at all. But let's say that was really only 10 hours is a more appropriate. Now again, watch the hourly rate, the $11. I'm going to change that from 12 to 10. And it actually went up, okay? And that's because you got the same cost components, but you're spreading it over fewer hours per day. So the hours per day is really, really important. I can't stress it heavily enough. If it's really only 8 hours, that goes from 11 to 13 and now to 16 dollars an hour. If the useful life is not 8 years, but maybe only they assess that it only is because of the wear and tear on it. Maybe they really only think that it has 6 years left on it. That's going to increase the hourly rate from 11 to 13, just with the useful life change. So I guess the bottom line is you have to be as accurate in your assumptions as you can possibly be. And that pertains to the production person, assessing the useful life in years, and also assessing the hours per day that it's used. I can promise you that when I have done in-depth pricing evaluations of clients, including this one, they were astounded at the actual usage being quite a bit less than what they really thought that it was. So that, I mention that because that may be an area that you might be interested in. And if you think you are, just go out to my website, www.pcramme, K-R-A-M-M-E, consulting.com, and you can see kind of what the deliverables are of a pricing evaluation. It primarily focuses on knowing what your current gross margins are, how you can increase, make adjustments to improve that gross margin, and then also, more equally important, is the actual hourly consumption of all of the labor parts and all of the equipment parts in the for the over a year's time. Now we
have a couple questions. Oh, good.
Yep.
Okay, I have two questions.
Now.
I have two questions from Albert.
Okay.
So 1 second here, and I'll unmute Albert. Go ahead, Albert. Do you have a microphone? Maybe not. So I'll go ahead and ask the question. The first question is, do I still include depreciation expense even though the asset is fully depreciated?
The annual depreciation, the column out here, is FYI, Albert. In a sense, it's the cost of funds that are coming in here, because the cost of funds are included in the total cost and therefore in the hourly rate. But the depreciation is there as a value, more as an FYI for the accounting people to say, all right, this is what the depreciation might look like versus what they are actually doing on the asset side in the balance sheet. So indirectly, it's including the cost of funds. If we change that to no, it takes it out of the hourly side, but it still expresses it as an FYI for the depreciable value that might be of interest. Does that answer your question, Albert?
He might not have a microphone. The other question that we have is, are we assuming that the hours per day are all chargeable hours? Paul, do you hear me? You're thinking.
I'm thinking.
Okay.
That is a tough one to address. I'm trying to widen this out so we can. We don't directly make any assumption on the productive hours in a for example, in an 8-hour day. In the pricing evaluation thing that I talked about, I believe I do in there, Albert, but here I'm not. In the if I were to do a financial analysis, detailed financial analysis, one of the variables that they tell me is, out of an 8-hour day, how many hours are they actually productive? That kind of injection could be included here, but it is not. So the answer to your question is specifically no. We back out the holidays so that we're only looking at Monday through Friday as far as the productive days, but the model does not take into account an assessment of how many hours a day are you estimating you're productive. It could, but it's not. Any additional questions?
No additional questions, Paul. Oh, wait. Yes, Albert doesn't have a microphone, and that was fine. Thank you. All right. No other questions.
I guess I'd be interested in Albert's comment on the productive hours, if that would be, if he feels that would be helpful, if that were to be added.
We don't have any other questions.
Yeah, I have found on the financial side, when I do a detailed financial analysis for clients, more and more are choosing not to make that assessment, and therefore they're keeping the productive hours at 8, for example. Some have tried it at 7, 7.5. But even on the financial side, my clients have tended to back away and not trying to make an assessment on the productive hours. Anything else? We got done quicker than I thought. Is there anything that I've not made clear to you? I want to make sure that I've not glossed over something too quickly that didn't make it clear. What you'll notice, I just thought of this, that in the example, they did not include any workstations. And that was because they told me that they had already combined it into the equipment cost. So you'll see on the examples up here, I just arbitrarily backed out 15,000 as an illustration from the 146, leaving the 131. So I did this up here in the samples as an illustration, whereas in the real world, this particular client had just the grand total, including the workstations. Again,
okay, I don't think we have any other questions.
All right, the results go into the unit cost field in control. And then the multiplier would be addressed kind of independently from this. I'm going to go back to the PowerPoint thing because I want to show you one more thing.
Just a quick question, Paul, or a comment.
Yeah. Okay.
On the worksheet, that section to the right is the calculator side of the tool. So do not add rows or columns or change that because it'll mess up the formulas.
Yeah. Thank you, Linda. Thank you.
Okay.
And I know, for example, this customer has 14 pieces of equipment. So we think for most businesses, 20 is enough. But you can approach how you use the calculator in different ways. If you want to be very selective on and do it at the specific machine that you're interested in, it might be based on the ones that you're using the most frequently. You might want to attack these if you've got multiple printers, for example. You might want to attack the updating of those in that particular category. So you can use the calculator 2, 3, 4, 5, 10 different times if you need to, and break it up into pieces. You don't have to do each and every machine. at the same time. It kind of goes along with what Linda was saying, that the don't change the rows. Just use it multiple times if you need to. Now, if you have questions or if you need assistance.
We have another question, Paul.
Okay. Let me just finish this train of thought and specific suggestions. You can reach me this way, and you can reach the Sirius Consulting Department at consulting@sirius.com. Okay, question?
Okay, the question from Albert is the purpose of the suggested cost multiplier to recover plant-wide overhead?
Albert, that's without going into a lot of nitty-gritty, ugly stuff. Several years ago, Sirius had me do a very, very detailed linear regression model to determine what in the heck we should start with for labor multiplier, what we should start with equipment, and what the multiplier should be for your materials, etc. And the overriding assumption that we settled on at that particular time was, let's keep the labor as consistent as we can and start with 2, multiplier of 2. We made the same assumption for equipment, start with 2. Then look at each one individually if warranted, and you are the one that can make that judgment call. For example, if on the in the database that I've got for control, let me go back to it. There's one particular machine in there. I think so, there's a couple. For some reason, this flatbed printer set up at 2.5. The Gerber Edge thermal printer was set up at 2.5. The rest of them are using the default or a value of 2. For the most part, where I see the advantage of deviating from 2 for equipment is if there's some overriding value added assessment that you conclude that you simply want to tweak how that is being billed by nudging the multiplier up. But it's purely judgmental. Albert, does that make sense to you?
He doesn't have a microphone.
Okay.
Oh, he said yes.
Okay.
All right.
Thank you, everybody. Have a great rest of the week. I'm going to celebrate my birthday tomorrow, so I'm going to do nothing. Take care, everybody.
All right.
Yeah. Have a great day. Bye.